Global economist at Morgan Stanley, who joins us live on the sidelines of the 6th India Investment Conference 2016, organized by CFA Institute. Hi, Manoj. Thanks so much for joining in this afternoon. Could you give us a brief analysis in terms of what's going on in China? Now, over the last few days, we have seen the currency stabilize at around 6.56 approximately. We're having the markets fall apart, though. What are you making of the data points that are coming out of there?
First, thanks for having me here. It's a pleasure to be here. China's always been an enigma for everyone, and I think the story that's coming out has created a little bit more panic than I think we should have in place. Let me walk you through the general backdrop that China's got. Sometime this time last year, there was real reason for concern because China's manufacturing sector had a pretty significant growth shock attached to it. And you saw that reflected in the global economy. Three things happened. Number one, you saw commodity prices coming down dramatically last year. They have come down this year in percentage terms, but not as much in dollar terms. Second is halfway through the year, the impact of that slowdown in China's manufacturing sector had a large slowdown attached to it as far as global trade was concerned, and that slowed the global economy down. And third, the impact was felt even in closed economies like the United States, where the export numbers weakened, not so much because of the US dollar, because that's what everyone would think, but it was more a China effect that came in through Canada and Brazil. Now, I think what we've seen is that the numbers really haven't turned into a more difficult trajectory in the recent past. The data has been all right. I think what has worried people is the uncertainty that surrounds the renminbi and the capital outflows. That is what is really creating concern as far as investors in the global economy are concerned. What we are seeing over there is a period through which the renminbi regime has shifted over the last 6 months. The global economy is just about getting to terms with it. They have now shifted from just looking at a single currency pair into moving the renminbi into a nominal effective exchange rate band. And as you come close to the top, or in this case, the bottom of the band, concerns around how far that currency could move have really weighed on the global economy. We think that the nominal effective exchange rate will depreciate much later in the year, but for now, that band is a stable one. This is not something that should worry the global economy excessively unless we start seeing concerns around China's growth story. In fact, what would be better is if China had some stimulus, not an excessive one because we already saw that in the post-crisis period, but they stabilize the domestic economy a little bit more. I think that would allay some of the concerns that have surrounded the currency.
Okay, so what you're trying to say, Manoj, is perhaps that the China slowdown fears are a bit overblown as of now because the fresh data points are not as bearish as they were in the past. So therefore, after this big 10% correction that we've seen across global indices, is it time to turn constructive on emerging markets?
Not yet. I mean, I'll point out a couple of things. I think you are right that at least on the data front, the concerns about China's slowdown are overdone because China has slowed down a while ago. It's just that unlike previous episodes, there has been no sharp move up after the stabilization, and we are expecting that. But if you look on the other side, you've got other stories. I think central banks in the developed economies have changed their tune. If you looked at this period a couple of years ago, the Federal Reserve, the ECB, and the Bank of Japan were all very, very, very willing to have an asymmetric response function. If the data was weak, they would stimulate aggressively. If the data was good, they wouldn't really react to it. That story has changed. I think what we've described as a global central bank peloton akin to the cycling races has really split into two. The Federal Reserve, the Bank of Japan, and even the ECB have now given some indication that they really don't want to ease aggressively because, according to them, the situation doesn't warrant it. And that has meant that the asymmetry that markets used to benefit from is not there. So there are some concerns besides China that are moving the story along. As far as your second question, is it time to become constructive on emerging markets? I think broadly not yet. You know, and I know that there is no such thing as emerging markets. They're all incredibly different. But what used to pull them together in the past is they would have a crisis. And when that crisis happened, all of them would bottom at the same time and then start picking up around the same time. That's not happening this time around. And hence, you have to be really picky. You have to start seeing which economies have bottomed, which one have passed a point of structural transition. And for us, there are four. We've got India in since December 2013. We've got Mexico and Indonesia since April of last year. And we've got Russia, which is one of the surprising ones, since September of last year.
All right, Manoj, let's come back to India then. What have you made of the recent data points that we got? The IIP data that come out recently. That's number one. Also, what are you factoring in terms of easing coming in from the RBI for 2016 itself? And also, what's your growth forecast?
For me, what's really important is the long-term growth trajectory. I think what investors and we ought to be focused on is whether you've got a trajectory that gives you India's growth sustaining itself over a 5 or a 10-year period. Certainly, it's going to be a very difficult period for India or any other economy to operate in this environment. And while China is going through this adjustment period, while U.S. growth is relatively weak, Brazil's in recession, I think it's difficult to expect any economy, whether it has transitioned or not, to give you a solid economic performance. So I think what I'm focusing on is the underlying thesis that could propel India's story ahead. And I've got about 3 elements to it. First, I'm not a big fan of having aggressive rate cuts. I think one of the things that will go wrong if you have aggressive rate cuts is when you're accumulating capital, you raise the risk of capital misallocation. So I like the fact that India's real rates will remain high for a period of time. Its growth is high too, don't forget, and the spread between the two is wide enough for growth to still take place. What that will do is it will prevent capital misallocation. If you've got 0 real interest rates, just about anyone can be profitable. You don't want that. The second thing that I think is important is the changes that are coming out of the administration are the ones that are increasing administrative efficiency. The need for reforms is tangible, but India's got low-hanging fruit from the inefficiencies that have been built up over the last decade that it can reverse. And the third thing is very simply, you've got a huge labor supply, but that labor supply pool by itself does nothing if you don't have capital efficiency and efficient administration. What you need is an allocation of capital that's to the right sectors that brings in the technology. So I'm more focused on getting the FDI story, getting the private sector stuck in, making sure that capital does not actually get allocated at a rapid pace, that you do not have a rapid pace of credit growth, and that the administrative efficiency increases. From what I have seen, yes, there will be fluctuations, it will be volatile, but the story is intact.
Okay, and very, very quickly, we're running out of time, Manoj. You were talking about central bankers. Is it possible, given the market turmoil, the Fed might decide to go easy on hiking rates this year? The dot plot suggests 4 hikes in 2016. Market estimates are at 3. Is it possible that we could see less than 3 hikes in 2016 by the Fed? And would that be a positive trigger?
Well, of course, the risk has always been that they slow down. They do it at a slow pace. They do it later than is suggested. Every time there's been a disinflationary shock for the last 2 to 3 years, they have slowed down. There is entirely a possibility for that. Most of that is probably still going to come from emerging markets. We need to look at them very carefully. But I think so far we should not dismiss the real possibility that the Federal Reserve could stick to their schedule. At least the forecast we have is for 3 rate hikes this year.
All right. Thanks so much, Manoj, for stopping by and, in fact, giving us all those views. But